Okay, imagine you're standing right at the edge of the stock market, and there are these two paths opening up in front of you.
Right.
One path looks like, well, pure acceleration, explosive growth, like you're strapping into a rocket ship aiming for the stars.
Oh.
The other path, it's quieter. It kind of whispers about hidden potential, like panning for gold or finding a diamond that just looks like a regular rock at first. Something overlooked, but maybe incredibly valuable.
Yeah, that's a great way to put it. The choice isn't always obvious.
Exactly. So how do you choose? That's what this deep dive is all about, understanding these two really fundamental ways people approach stocks in the U.S. market, growth versus value.
We're going to unpack what makes them tick, what defines them.
And how investors actually try to find these kinds of companies. We've got a stack of articles, some academic research too.
Yeah, quite a bit of material.
And our mission today is basically to sift through all that, pull out the key insights, and give you a really clear picture of the differences, the potential, maybe even find some surprising connections.
That's the plan. Because, as the sources show, growth and value aren't just labels for stocks. They're really distinct investment philosophies, different ways of looking at the whole game.
Okay, let's dive right in then. Starting with the basics. What is a growth stock based on this material?
Fundamentally, growth investing is all about the future. It's focused on potential, specifically the potential for really rapid, above average expansion.
Above average compared to what?
Compared to their competitors in the same industry or just the market overall. Growth investors are looking for companies they expect to boost their earnings or their revenue or just grab more market share much, much faster than everyone else.
So it's not about today's profits necessarily?
Not primarily, no. The big driver is the anticipation of major growth and bigger profits down the road. These are often younger companies, maybe smaller ones, poised for that quick expansion. Think disruptors, companies moving into totally new areas.
Gotcha. Betting on acceleration, future scale, even if they're not rolling in dough right now.
Precisely. They're usually pouring money back into the business to fuel that growth, not handing it out as dividends. Now, value stocks, that's a whole different mindset.
Right, the bargain hunters.
Exactly. Value investors are searching for stocks they think are trading for less than they're actually worth, less than their intrinsic value or their book value.
So finding companies the market has somehow misjudged.
Yeah, that's the core idea. Finding present undervaluation. Maybe the company had some temporary bad news, or it's in an industry that's just out of favor, or maybe it's just plain overlooked. The value investor thinks the market is underestimating it right now.
Okay, so growth chases tomorrow's potential, value grabs today's mispricing. That NerdWallet source had a handy table summarizing the surface differences, right?
It did, and it's a really good starting point to see the contrast. Let's run through those quickly.
Okay.
First, price. Value stocks, seen as currently undervalued compared to what they should be worth. Growth stocks, often trading at a premium, their price looks high based on current numbers.
Because people expect big things later.
Exactly.
Yeah.
Which leads to the PE ratio, price to earnings. Classic difference here. Value stocks tend to have low PE ratios. Their price is low relative to their current earnings.
Makes sense.
Growth stocks, usually the opposite. Above average, often really high PE ratios. Investors are willing to pay way more for each dollar of current earnings because they're banking on massive future earnings growth.
Okay. What about dividends?
Dividends. Value companies, often more mature, profitable now, tend to pay out some profits as dividends, so often high dividend yields. Growth companies, they usually reinvest pretty much everything back into the business to grow faster, so low or zero dividends.
And risk. NerdWallet put that a bit differently for each.
Yeah, they framed it like this. For value, the risk is the stock might just fizzle. It might not appreciate like you thought. The market might never see the value, or things could get worse for the company.
So a value trap.
Could be. For growth, the risk is more about volatility. Because the price is so tied to future hopes, any slip-up, any failure to meet those super high expectations can cause the price to drop sharply.
High potential, high drama.
You could say that.
All right, that initial comparison really lays out the different philosophies. Let's follow that rocket ship path first and get deeper into growth investing.
Sure. So the big appeal, obviously, is the shot at massive returns if you pick a winner early. But, as Investopedia emphasizes, it's inherently risky.
Because these companies are often unproven.
Right. They might be in really competitive fields. Maybe they've borrowed heavily to expand. Maybe the whole business model is still kind of experimental at scale. The chance of not meeting those growth targets, or even the business failing completely, it's significant.
High stakes indeed. So how do growth investors try to pick winners? What specific things are they looking for beyond just a good story?
Well, Investopedia breaks down a few key factors. A huge one is earnings growth past, but especially future.
Future growth is the main game.
Absolutely. They scrutinize earnings estimates from analysts very closely. They're looking for companies where the consensus forecast is for profits to grow way faster than the industry average or the market overall. They need to see sustainable, rapid earnings expansion ahead.
So it's not just about what they did last year, but what analysts think they'll do next year and the year after that.
Exactly. And another key metric is profit margins. They often focus on the pre-tax profit margin.
Why pre-tax?
It shows how much profit the company makes from sales before taxes kick in. You can have amazing sales growth, right? But if costs are ballooning just as fast, that growth isn't hitting the bottom line.
Ah, okay, so they want efficient growth.
Precisely. Growth investors want proof management is keeping costs under control while scaling up. A good sign, according to the source. If the company's pre-tax margin is better than its own average over the last 5 years and higher than its industry peers, that suggests profitable growth.
Got it. Profitability while growing. What else?
Return on equity, ROE, is another big one. This measures how much profit the company wrings out of the money shareholders have invested. You calculate it as net income divided by shareholder equity.
And high ROE is good.
Generally, yes.
Yeah.
It suggests management is using capital effectively, running the business efficiently to generate returns. Growth investors like to see stable or, even better, increasing ROE compared to the company's own history and its competitors. It's another check on the quality and sustainability of the growth.
Okay. And Investopedia mentioned a sort of rule of thumb about share price potential.
Yeah, kind of an interesting heuristic some aggressive growth investors might use. They ask, can this stock realistically double in 5 years?
Wow, double in 5 years.
Yeah. If they don't see that kind of potential, it might not make the cut for their growth portfolio.
Yeah.
The math is simple. Doubling in 7 years needs about 10% annual growth. Doubling 5 needs closer to 15% a year.
Which is pretty fast.
It is. But it's considered doable for, say, young companies and fast-moving industries, the typical hunting ground for growth of stocks, although you can find them anywhere, technically.
It definitely highlights the ambition there, not just growth, but rapid growth.
It does. And, this whole approach has its heroes. Thomas Rowe Price Jr. is often called the father of growth investing. He started the first growth mutual fund, T. Rowe Price Growth Stock Fund, way back in 1950. It averaged 15% a year for over 2 decades.
Impressive.
Then there's Philip Fisher. He wrote Common Stocks and Uncommon Profits. He really stressed deep qualitative research, even talking to customers and competitors, networking, basically to truly understand a company.
Beyond just the numbers.
Right. And we can't forget Peter Lynch from Fidelity's Magellan Fund. He championed his sort of hybrid strategy called JARP growth at a reasonable price, trying to find that sweet spot between growth potential and not overpaying wildly for it.
Interesting. So variations on the theme. Let's make this concrete. Amazon is often used as the classic growth example, right? Even when it got huge.
Oh, absolutely. AMZN is a perfect case study. Even back in early 2021, when one source looked at it, it was already one of the biggest companies in the U.S.
Massive.
But it's still traded at a really high PE ratio, like upwards of 70 sometimes, maybe around 60 back then. That screams growth stock. Investors were paying a huge premium for every dollar of Amazon's current earnings.
Why?
Because the expected earnings growth was insane. The source mentioned estimates around 30% per year for the next 5 years. That's the growth story in action. Buying above what seems like current value because you have enormous expectations for future profits justifying that high price tag.
Okay, that really clarifies the growth mindset, paying a premium for future potential. Now let's shift gears completely. Let's walk down that other path. Value investing, the hidden gem hunt.
Right. Value investing, as we said, is fundamentally different. The goal is finding stocks the market is currently selling cheap, basically, undervaluing.
Companies trading for less than their true worth today.
Exactly. Finding those overlooked bargains.
And this is where it bumps up against that big academic theory, the efficient market hypothesis.
Directly. Value investing basically requires a belief that the market is not perfectly efficient, at least not always.
How so?
Well, the efficient market hypothesis, EMH, especially the semi-strong form, which is kind of the academic consensus, says that stock prices reflect all public information instantly. If that were totally true, using public financial data, a value investor's main tool shouldn't let you consistently beat the market after accounting for risk. Any bargain would be gone in a flash.
But value investors obviously don't buy that completely.
Not at all. They believe markets often misprice stocks in the short or medium term. Prices can get disconnected from underlying value because of, well, human behavior.
Like what?
Market overreactions to news, panic selling during downturns, crazy excitement blowing up bubbles, or just plain neglect stocks in boring industries, maybe not covered by analysts, just ignored. Value investors see these moments of inefficiency as their buying opportunities.
Okay, so if the market messes up, how does a value investor figure out what a stock should be worth? That sounds like the detective work.
It really is. The main job is figuring out a company's intrinsic value. This means digging deep into financial analysis, looking at all sorts of fundamental factors.
Is there a formula?
Not really one single formula, no. That's why it's often called more of an art than a science. You're interpreting data, making judgments about the business, its management, its future prospects, though maybe less focused on super fast growth than a growth investor and its competitive landscape. There's definitely some subjectivity involved.
What kind of metrics do they use for this art?
Several key ones come up in the sources. Price to book, PB, is common. It compares the stock price to the company's accounting value per share assets minus liabilities. A low PB might mean it's cheap relative to its assets.
Unless it's cheap for a reason.
Right, you have to check if the company is genuinely distressed. Then there's price to earnings, PE again, but value investors want it low. Low price relative to current earnings might signal undervaluation, assuming the earnings are stable.
Okay.
Free cash flow, FCF, is super important too. That's the actual cash the business generates after covering operating costs and investments in things like equipment.
Real cash, not just accounting profit.
Exactly. FCF shows the company's financial health and flexibility. It's the money available to pay down debt, invest more, pay dividends, buy back stock. Strong FCF is a good sign.
And they look beyond just those ratios.
Oh yeah, they dive into debt levels, the quality of the assets, sales trends, revenue growth, even if it's slow and steady, brand strength, the business model's resilience, competitive advantages, or moats, as Buffett calls them, and who their customers are. It's a full checkup.
Really getting into the nuts and bolts of the company's current situation and stability.
That's the goal, looking for tangible underlying value. And maybe the most important concept in value investing, the one linked heavily to Benjamin Graham, is the margin of safety.
Margin of safety, explain that.
Okay, so you do all your analysis, you come up with your best estimate of the company's intrinsic value per share. Let's say you think it's worth $50. You don't buy it if the market price is $50.
No, why not?
Because you want a buffer, a margin of safety. You aim to buy it at a significant discount to your $50 estimate. That discount is your protection.
How big a discount are we talking?
Well, Graham famously suggested buying at 2/3 or less of the intrinsic value, sometimes even liquidation value, for very conservative plays. The point is, if your $50 estimate was a bit optimistic, or if it takes the market a while to recognize the value, buying at, say, $33 gives you that cushion. It minimizes your downside risk while you wait for the price to hopefully rise towards $50, and maybe the intrinsic value itself keeps growing too.
That sounds like it requires serious patience, which fits with another trait, right? Value investors often have to go against the crowd, be contrarian.
Absolutely essential. You're often buying when everyone else is scared and selling maybe during a market panic. That requires resisting loss aversion.
And holding back when everyone else is piling in.
Exactly. Resisting FOMO, the fear of missing out when stocks are soaring. You avoid the hot, trendy stocks because they're usually overpriced based on fundamentals. Instead, you might be looking at solid, maybe boring, established companies that are just out of favor. Think Procter & Gamble versus the latest tech darling.
So discipline to ignore the noise and trust your analysis.
Totally. Which leads to the two big requirements: diligence and patience. Diligence is the homework, the deep dive into financials, understanding the business, refining your method. Patience is crucial because value plays can take years to work out. You have to be willing to hold on, wait for the market to catch up to your assessment.
And sometimes that means just waiting.
Yes, the waiting game. Being okay holding cash if you just don't see any stocks meeting your strict criteria at a good price with that margin of safety. You can't force it.
Okay, so if markets aren't always efficient, why do these bargain opportunities pop up? What causes the mispricing?
The sources point to a few key reasons, mostly tied to psychology and market structure. One big one is just market moves and herd mentality. We talked about FOMO and loss aversion. These biases make investors act irrationally, pushing prices away from fundamental value.
People follow the crowd, emotions take over.
Right. And you really see this during market crashes. Think about the dot-com bust or 2008. Bubbles inflate prices way beyond reality. Then they burst, panic sets in, and people sell everything. good companies and bad, creating massive undervaluation across the board,
Opportunities for the calm investor.
if they have the stomach for it. Another factor is stocks being unnoticed and unglamorous. Maybe it's a small company or in a boring industry, not much analyst coverage, no media buzz. Investors chase the exciting stuff, ignoring solid businesses trading below value just because they're under the radar.
So being boring can be good for value.
It can help keep the price down, yeah. And finally, cyclicality. Economies have cycles, industries have cycles, even consumer moods shift. This can cause temporary dips in a company's earnings or stock price that don't necessarily affect its long-term worth. A value investor looks past the temporary dip.
Okay, so how do they put this into practice? What are the actual tools and strategies for that deep dive into a company?
Well, it starts with some common sense questions about the business itself. Can they realistically grow revenue? How? Raising prices? Selling more? Expanding? Can they cut costs? Should they sell off parts that aren't working? Understanding the competition is key too.
And Buffett's advice.
Always relevant. Invest in what you understand. Don't stray into industries you can't grasp. Another signal some look at is insider buying. If execs or directors are buying shares with their own money, it suggests they're confident.
But the core is really digging into those official reports, right? The 10Ks and 10Qs.
Absolutely. That's the bedrock. The financial reports filed with the SEC, the annual 10K, the quarterly 10Q. You find them on the SEC's EDGR site or the company's investor relations page. They're full of info products, strategy, risks, management's view.
And inside those reports, the key financial statements.
Yes, the big three. First, the balance sheet. It's a snapshot. Assets, what the company owns, cash, inventory, equipment, versus liabilities, what it owes, debt, accounts payable, plus equity, the shareholder's stake. You look for things like manageable debt and growing retained earnings profits reinvested over time.
Okay, balance sheet is the snapshot.
Then the income statement, or P&L. That shows performance over time, revenue, cost, expenses, and ultimately net income or profit. Looking at the annual statement helps smooth out seasonal bumps.
Got it.
And third, the statement of cash flows. Maybe the most crucial. It tracks the actual cash moving in and out from operations, investing activities, and financing activities. It cuts through some accounting ambiguities and shows if the business is truly generating cash.
That sounds like a ton of data. I've heard the real secrets are hidden in the footnotes, though.
That's often true. The sources stress reading the footnotes. They explain the accounting methods, break down numbers, detail debt terms, lawsuits, stock options, all sorts of critical stuff. If the footnotes are murky or confusing, that's the potential red flag.
And watch out for extraordinary items.
Definitely. These are supposed to be one-off gains or losses, like from a lawsuit or restructuring. But you need judgment. If a company has extraordinary items all the time, maybe they're not so extraordinary, maybe it signals recurring issues. Same goes for frequent write-offs.
So it's about the whole story, not just the headline numbers. Even with all this work, what are the main risks value investors still face?
Several pitfalls. Obvious one, inaccurate analysis. Your intrinsic value estimate could just be wrong. Or you might misinterpret the financials, miss a crucial footnote, misunderstand a ratio. Ratios themselves aren't perfect. They can be calculated differently or distorted.
And not having that margin of safety.
Big risk. Failing to apply a sufficient margin of safety leaves you exposed if your valuation was off or things go unexpectedly wrong. There's also the diversification debate. Graham suggested maybe 10-30 stocks. Some say even more. Others argue for concentrating on fewer, best ideas for higher potential returns, but that's much riskier if you're wrong.
It's a trade-off, and you said the biggest risk was
listening to your emotions. Hands down. Value investing demands patience and going against the grain. If fear makes you sell low or excitement makes you chase a high price, you're abandoning the whole analytical approach. Discipline is key.
Really shows how temperament matters. Can you give a quick example of how market freakouts create these value chances?
Sure. One mentioned was Fitbit back in May 2016. They released earnings, actually met or slightly raised their guidance for the year, but the stock tanked after hours, like almost 19%.
Ouch.
Maybe guidance wasn't raised enough for sky-high expectations. Who knows exactly? But from a value perspective, that looks like a potential market overreaction. Ignoring solid results because of short-term sentiment, a value investor might see that sharp drop as a chance to buy a decent company cheap, thanks to emotional selling.
That perfectly illustrates the price versus value disconnect. It reminds me of Graham's famous analogy, Mr. Market.
Yes, Mr. Market. Brilliant concept. Graham personified the market as this manic depressive business partner. Every day, Mr. Market shows up offering to buy your shares or sell you his.
Every single day.
Yep. Some days he's wildly optimistic, euphoric, offering crazy high prices. Other days, he's panicked, depressed, desperate to sell cheap.
And the point is?
The point is, you don't have to trade with him. Don't sell just because he's depressed. Don't buy just because he's euphoric. Use his mood swings. Buy from him when he's offering bargains. If your analysis says it's a bargain, maybe sell to him when he's offering silly prices. Your decisions are based on your analysis of value, not his mood.
Such a great way to think about market psychology and staying disciplined. Okay, so we've got growth, chasing the future, and value, hunting for today's bargains with a safety net. But the sources suggest they're not always separate worlds.
That's really important. NerdWallet points out you can definitely blend them. A diversified portfolio might have both growth and value stocks. Plus, companies change.
How so?
A young, fast-growing company might start as pure growth. Then it matures, gets profitable, maybe starts paying dividends. It could morph into more of a value or dividend play. Or a struggling older company's stock drops so low it becomes a value target. Then if it turns around, it might even re-enter a growth phase. Stocks evolve.
And the market environment matters too. Sometimes growth is hot, sometimes value.
Exactly. Market cycles definitely favor one style over the other at times. NerdWallet mentioned the Russell 1000 growth versus value indexes. Growth crushed value from 2009 to 2020, driven by tech. But other periods, value has led. Holding both gives you diversification against those cycles.
Right. Now, let's layer in that academic angle from the Lund University paper. It digs into how fundamental analysis actually performs, especially within value.
Yeah, this paper tackles it head on. It acknowledges the efficient market hypothesis, EMH, background. The idea that prices reflect all public info, so fundamental analysis shouldn't give you an edge.
But then it challenges that.
It does. It immediately points to a growing pile of academic evidence suggesting markets aren't perfectly efficient, especially short-term. These studies suggest fundamental analysis can potentially generate abnormal returns, better returns than risk alone would justify.
What kind of evidence? What are these anomalies?
The paper lists several examples where stock prices seem to react to fundamental news in ways EMH wouldn't predict. Things like post-earnings announcement drift, where stocks keep drifting up after good earnings news, or down after bad, instead of adjusting instantly. Also, weird returns linked to dividend changes, new stock issues, share buybacks, and how companies manage accruals, those accounting entries that affect reported earnings, but not necessarily cash flow. It suggests the market doesn't always price things in perfectly right away.
So, academic hints that fundamentals might pack more punch than theory suggests, which brings us to Joseph Piotrowski's work, applying fundamentals specifically to value stocks.
Exactly. Piotrowski did something really clever. He took the universe of value stocks, typically identified by a high book-to-market ratio, meaning the stock price is low relative to the company's accounting value, and said, okay, not all these cheap stocks are good bets. Some are cheap for a reason, they're dying. Others might be cheap but are actually strong or getting stronger.
And he developed the F-score to sort them out.
Precisely. His F-score is a simple 0 to 9 scoring system based on 9 fundamental signals from the financial statements. The goal: to find the financially strong companies within that group of generally distressed-looking value stocks.
What kind of signals?
They fall into 3 buckets. First, profitability. Is the company profitable now? Positive ROA. Generating cash from operations? Positive CFO. Is profitability improving? Higher ROA than last year. Are earnings quality good? Accruals not suspiciously high. You get points for positive signs.
Okay, profitability checks.
Second, leverage and liquidity. Is the company's debt level going down or staying stable? Is its ability to meet short-term obligations improving? Higher current ratio. Did it avoid issuing more stock, which can dilute existing shareholders? Points for signs of improving financial stability.
Balance sheet health.
Yeah.
Got it.
Third, operating efficiency. Is the company getting better at turning sales into profit? Improving gross margin. Is it using its assets more effectively to generate sales? Improving asset turnover. Points for better operations. A high F-score, like 8 or 9, flags a value stock that looks fundamentally solid and improving. A low score, 0 or 1, suggests a weak one.
It's like a systematic health check for value stocks. What did Piotrowski find when he tested it?
The results were pretty stunning. His original study, looking at U.S. stocks from 1976 to 1996, found that high F-score value stocks blew away low F-score value stocks, and a strategy of buying the high scores and shorting the low scores. It generated an average market-adjusted return of 23% per year.
Wow, 23% above the market. That's huge.
It was massive. Strong proof that fundamentals could really separate winners from losers within the value category. And crucially, he found the strategy worked best for small and mid-sized companies.
Did the newer Lens study find the same thing for a more recent period?
Yes. The Lund paper replicated the strategy from 2003 to 2015 in the U.S. market and got very similar results. They confirmed high F-score value stocks significantly outperformed low F-score value stocks after adjusting for market returns. They found a clear, statistically significant return difference.
And the size effect held up too, better for smaller firms.
Absolutely. Just like Piotrowski, they found the F-score strategy was most powerful for small and medium-sized firms. When they looked only at large-cap value stocks, the F-score didn't really distinguish winners from losers significantly in that period. It seems this fundamental filtering is particularly effective among smaller value names. The thinking is the F-score picks up improving financial health, better profits, efficiency, balance sheets within a group often just seen as cheap and struggling.
Okay, so academic research seems to back up the idea that focused fundamental analysis like the F-score works within value, especially for smaller stocks. But then there's a big finance debate. Is it risk or is it mispricing?
That's the million-dollar question the paper dives into. Are these higher returns just compensation for taking on some kind of hidden risk that standard models don't capture? Or is the market genuinely mispricing these stocks, allowing smart analysis to profit?
And can we know for sure?
That's the tricky part, what academics call the joint hypothesis problem. When you test for abnormal returns, you're testing two things at once, your risk model and market efficiency. If you find excess returns, you can't be 100% sure if it's because your risk model is flawed or because the market is truly inefficient. They're tangled together.
So the higher returns could just be payment for some extra risk factor associated with high F-score value stocks that we haven't identified yet.
Exactly. That's the challenge. The Lund study acknowledges this. They conclude they can't definitively rule out that the returns are just risk compensation, partly because of this theoretical problem and partly because they didn't do exhaustive risk adjustments in their specific paper, though Piotrowski did try in his original.
Which brings us back to the other explanation the paper explores, behavioral finance. Maybe it is mispricing driven by psychology.
Right. Behavioral finance argues that human biases lead to systematic errors and mispricings. The paper mentions heuristics and biases, those mental shortcuts that can lead us astray.
Like assuming a cheap stock must be a bad company.
Yeah, that could tie into representativeness. Or anchoring getting stuck on past bad news or low earnings, causing investors and analysts to underestimate improving fundamentals in value stocks. They get neglected.
Okay.
Then there's overconfidence, or being too optimistic or pessimistic. Maybe analysts get too bullish on companies they cover, puffing up growth stocks. Or maybe investors get too gloomy during downturns, pushing value stocks too low. Add in herding behavior, everyone following the crowd.
So the behavioral story is these biases cause mispricings, especially undervaluing neglected value stocks, and strategies like the F-score work by applying a rational filter.
That's the essence of it. And the paper adds one more piece. Limits to arbitrage. Even if rational investors spot mispricings, things like transaction costs, difficulty shorting, or just lack of liquidity, especially in smaller stocks, can stop them from fully correcting the prices.
So the errors can persist.
Exactly. And the fact that the F-score works best in small mid-cap stocks where liquidity is lower and arbitrage harder kind of supports this idea that limits to arbitrage might let these value anomalies hang around.
Wow, okay. This has been a really comprehensive look at growth and value, from the basic ideas to the academic debates. Let's try to bring it all home. What does this mean for you listening to this, trying to navigate the market?
Well, first off, just understanding that these two distinct philosophies, growth and value, exist is huge. It gives you a framework. You can see why different investors favor different kinds of companies and why the market might react the way it does sometimes.
And it gives you tools and a different way to look at things.
Totally. We've talked about specific metrics, PE, PB, ROE, FCF methods like analyzing financial statements, concepts like margin of safety. Plus, you now have this lens of market efficiency versus behavioral finance. It helps you think more critically.
And it's not necessarily about choosing a side, right? You don't have to be just a growth or just a value investor forever.
Not at all. Many successful investors blend the approaches. You might lean one way or build a portfolio with both for diversification. The key is knowing the fundamental differences, the tools, the potential pitfalls, and even the academic research helps you make more informed choices that fit your goals and how much risk you're comfortable with.
Okay, let's sum it all up. We've explored these two contrasting worlds, growth investing, chasing the rocket ship of future potential, often paying a premium for expected speed, Value investing. Hunting for hidden gems, stocks undervalued today, using deep analysis and demanding a margin of safety.
We looked at how investors try to find them, projecting earnings for growth, digging into PB, PE, cash flow, and financials for value.
And we layered on that academic view, particularly Piotrowski's F-score, showing how systematic fundamental analysis seems to help pick stronger stocks within the value universe, especially smaller ones, which led to that whole debate.
Right. Is it unmeasured risk, or is it market inefficiency driven by behavioral biases like neglect and anchoring, allowing these strategies to work?
It really underscores that investing isn't just numbers. It's about understanding the market, the companies, the discipline, and maybe even a bit of psychology.
Absolutely.
Which leaves us with a final thought for you to chew on. Given this persistent evidence, even in recent studies, that value strategies combined with fundamental checks like the F-score seem to deliver extra returns, particularly in smaller companies. Does that mean parts of the market really are inefficient? Or are we just missing some hidden risk? And thinking about behavioral finance, how much of an edge can you gain simply by understanding your own biases and the potential biases of others when you're looking at these two very different but connected paths in the market? Something to consider next time you analyze a stock.